Thank you very much for that. Let's invite Jyotivardhan Jaipuria, founder and managing director, now Valentis Advisors, on the show now. Jyoti, morning, and thanks so much for joining in. Your read on the market is last year, any bad news in the economy was read as good news. But now, as we enter 2023, as recession fears grow, bad news in the economy will be read as bad news. Can you tell us what the implications are from a market point of view in terms of expectations and returns?
Yes, Seema. So, last year was all about the Fed, all about, inflation going up and Fed hiking much more than what the market thought. Um, my view is that we are probably coming closer to the end of the Fed hike. We'll probably have hikes in the next two meetings. And then, Fed will probably go into a long pause. The market believes that they will start cutting by the end of this year. The Fed says no at the moment. But what the market's focus will shift to is the economy and earnings, because I think earnings in US could probably be negative. Earnings will be downgraded across the world. GDP also will get downgraded, and that's where the fear will shift to that: are we getting into a recession in US? Are we getting into slower growth everywhere in the world? And that's why my thing is, like, so far, even now, I think over the next few weeks, any bad data on the economy will probably be positive for the markets. People will take it positively. But as we move into the course of the year, we'll find that bad data on the economy is actually bad news for the market and not good news.
Okay, Jyoti, a happy new year to you and thanks for being with us on the channel. Looks like it's a year where we have to grapple with a lot of things, right? Higher interest rates, lower growth, high inflation. Amidst all of this, where do you see places to hide? Which are the spots where you think could, forget about delivering alpha. It looks like a tall ask at the moment, but at least spaces that could outperform the market.
Yeah, happy New Year, Sonia. So, one is we still continue to like the banks. They've done well last year. So, we're not going to get the same sort of returns from the banks which we got in the last year. But I think that's one area which will continue to outperform even when these results come. A lot of the earnings growth in India is going to come from the banks. The other place where things will be good, I think, from a stock market point of view, is sectors which got hurt last year because of the high commodity prices. So essentially, you had very strong top line growth in some sectors, but margins totally got eroded because the input costs were very high. This year we'll probably have the reverse. Top line will probably slow down a bit, but margins will normalize. Margins will be very strong, and so you'll see earnings growth coming. A lot of these stocks are down 25-30% from where they were a year ago, and that's where things will be good. So just to give you one example, it's probably cement is one example where last year a lot of input cost pressure, and this year, input cost pressures have eased. So just because of the cost cut, we could see like a 200 rupees per ton increase coming in cement EBITDAs.
Okay. Mr. Jaipuria, good morning and thanks for joining us. This is Pavitra. What do you think of the IT space now? We just had TCS post earnings, not too bad at all, but they're not really providing much clarity on what's going to happen in the future. The rest of the earnings will also come through this week, but do you think that this is a good time to maybe start buying into IT because we've seen such a big correction, or do you think there's lots more pain in this space?
Yeah, Pavitra, so like right from a year ago, our theme has been just avoid the global plays and focus on the domestic plays, because there's more visibility on the domestic plays. We know that the economy is doing fairly well. That will slow down a bit, but not too much. On IT specifically, you've seen like valuations come up substantially for where they were at the peak. But even then, the demand environment is cloudy, especially if we get into a recession in the US. Then, in the second half of this year, a lot of them will start saying that we don't have visibility on the order book. And that's the reason we are trying to avoid it at the moment. No need to rush into it.
Mm. Jyoti, if emerging markets are going to outperform the Indian markets, how do you expect foreign flows to come into India? Because anyway, we've had 7 good years on the trot. There is a case to be made for other emerging markets to play catch up where the valuations are far more reasonable. And then you've got fundamental triggers like China reopening, which has implications for the Taiwanese markets because of the semiconductor linkages, Hong Kong, etc. Do you expect India to see, how do you expect foreign flows into India this year?
Yeah, so see, Rima, there are two things on the foreign flows. One is, the absolute and the relative. So last year, if you see, India outperformed, but foreign flows were hugely negative. We got like close to $16 billion of outflows last year. This year, I think what will help emerging markets is basically that the dollar has probably peaked off and the dollar will weaken. It will not strengthen like it has for the last 8-10 years. So to that extent, in general, emerging markets will probably do better than developed markets. So when that happens, like everybody tends to get more flows because more flows are going to emerging market. Just remember, India now is the second largest weight in the MSCI Emerging Market Index. So to that extent, there's some flow which comes naturally. Second is within emerging market, we'll probably get lesser flows than what we deserve because of our weight. Because one is last year, like you said, it was one of the strongest performing markets. And second is if you look at valuations, we are like extremely expensive relative to the whole emerging market peer. We are trading at over 100% PE premium to emerging markets. So to that extent, you'll probably see some of the flows going more towards countries which are cheaper countries which did badly last year. So I think India underperforms the emerging market, but it still maybe we may still get better flows than we got last year, just because the emerging market pack comes more into focus.
Jyoti, thanks for joining in. We've run out of time, but not out of questions. We will chat again very soon. Thanks for being with us on the channel. But
Thanks.
all roads are leading to the Auto Expo 2023. It's underway after 3-year hiatus. The Auto Expo is back. My colleague Parikshit Luthra is right there. He has the